task 3. This is the percentage change analysis, but now we're going to be looking at the balance sheet. So, using some of the same tools we used yesterday, but now we turn our focus to the balance sheet. So, balance sheet is using some of the different elements. So we will be using owner's equity, and then assets and liabilities. These are the other 3 elements. So income statement has revenue and expenses. This is using owner's equity, assets and liabilities. And that's actually the layout of a balance sheet. So when you start to prepare a balance sheet, you'll start by listing out your assets and then finding our liabilities, listing out those, and when you have assets minus liabilities, that's a thing called net assets. So net assets. Now net assets should equal owner's equity, which is the last part. Owner's equity can come up here or up the top, down the bottom, it doesn't matter. But what's important in a balance sheet when you put it together is that assets minus liabilities should equal your total owner's equity. And the balance sheet is in balance. So all this information will come from the trial balance. In the trial balance, you have some things on the left which are debit, some things on the right which are credit. Your assets and expenses are debits, liabilities, owner's equity and revenue are on the right. So you'll have a big list, and if you see your example in your workbook, you'll see there that there's a whole lot of assets, a whole lot of liabilities, and some owner's equity items. Another owner's equity item that we've got in there is called retained earnings. So retained earnings is just past year profits. So past year profits get added to owner's equity that belongs to the owner. Right, so you've got the layout. Now we're going to be splitting things into the categories current and non-current. So assets, you're going to have some current assets. Now current assets are the assets that will turn into cash or are already cash or will be used up in the next 12 months. So that's going to be your current assets. Examples of current assets are bank, inventory or debtors, or sometimes prepaid expenses if you have them. Non-current assets, these are the ones that you're going to be holding on for a long time. And non-current assets, so you're going to hold on to them for more than 12 months. And these are the things like fixed assets that you are going to keep and help you run your business. So you've got equipment, land, your buildings, vehicles, computers. All of these things are what's called non-current assets. Important thing when we start to look at some fixed assets is that there's this little thing called depreciation. Okay. So when we have our fixed assets, these are our physical assets that we keep, that we use in our business. So we record them, and this is the debit side, as the cost price. So that's how much it cost to buy them originally. However, when you think about those things, these things wear down over time. So the more we use them, the more they get depleted, and their value will go down. Just think of a vehicle, a car. You buy it, you might buy it for say $20,000, but what happens over 5 years' time? Over 5 years' time, you've used it a lot, put a lot of kilometres on it, it's not worth the same value. So this reduction in value is what's called depreciation. So depreciation is the reduction each year of a fixed asset because it's been used. Now on the balance sheet, we add up all these depreciations, or add up the reductions in value, and that's what's called accumulated depreciation. Okay. What we do is we take it away from the cost price. So this is how much it cost us. We minus how much it's decreased in value, and that gives us a book value. A book value is just its current value on paper. That's why it's called a book value. So book value, it's value on paper on the accounting system. The value might be slightly different in the real world, but that's what we think it's worth. So you're going to have some things on the balance sheet that are going to look like this. Total up all the cost prices of all the fixed assets. Then you're going to be minusing accumulated depreciation. That's how much it's gone down in value. And then that will give you the book value. So that all goes into the non-current assets. Right, liabilities, we have the same split of current and non-current. So current liabilities, these are liabilities that we will pay off within the next 12 months. So these are things like accounts payable, which is often called creditors, maybe tax as well, sometimes also accrued expenses. Accrued expenses are expenses that we have yet to pay, that we haven't been billed for, but we know that are going to happen, like insurance. Okay, and non-current liabilities. These are our long-term liabilities that we pay over the long term. So again, we look at our mortgage, loans. These are our common ones that are long-term. Now when you're preparing these, again, we're going to be doing it for 2 years. So 2016, 2017. Once you've done those, you can then do the same 2 columns. Sorry if this is really in the top corner. You'll have a column there for dollar change, which will be the 2017 figure minus 2016 equals the dollar change. And then finally the percentage change, which is the dollar change divided by 2016, the original figure. Using the percentage change formula, which I've got on the side here, new minus old divided by old times 100. Once you've done that, you can start to analyse. What would be favourable for each item? What is a favourable change in assets? Assets going up generally is a good thing. What about owner's equity? Well, owner's equity is the same. Because it comes back to this equation. Now, this is the equation of the balance sheet. Now, if your assets are going up, to make this work, well, very often owner's equity will also be going up. But the other way it can work is that, well, maybe liabilities is going down. Again, owner's equity going up is a favourable thing. Not so favourable is this situation. If liabilities, say, were the only thing to go up, then that would mean our owner's equity would be going down. Or alternatively, maybe assets are going down. So therefore, owner's equity also has to go down. Generally, if the result is owner's equity is going up, it's a favourable thing overall in the business. Now, you'll see in your slide there, there are some relationships between items. So for example, you may have a mortgage that's increased, so a non-current asset can be purchased. This is okay because the assets are linked, and hopefully that asset will generate more revenue. But the other side of it is that if you borrow more money, of course you'll have more interest expense in the future. So there can be a positive and a negative between both things. Okay, so give it a go using the balance sheet. Construct the balance sheet for 2 years.